You've tuned into Dinar Shift, and what a spectacle the global currency markets have delivered. If your attention has been focused elsewhere, over the past couple of days, you may have missed one of the most remarkable and discussed market movements of the current trading period. The pivotal 0.86 exchange rate level has once again surfaced, triggering a wave of intense activity among currency traders worldwide. This reappearance is being greeted by many as a unique and perhaps rare market occurrence, echoing the massive stir it caused just a few months prior. This is not simply a random temporary fluctuation or a small, short-lived peak on the charts. It is the re-engagement of a highly significant technical benchmark that has previously been a catalyst for substantial trading opportunities for countless participants. This significant market action demands a comprehensive breakdown, and that is precisely what we are here to provide. We need to dissect the elements contributing to the widespread fascination with the 0.86 level, identify the primary currency pairings exhibiting the most pronounced movements, and explore the established, practical methodologies that traders employ to navigate this dynamic environment. By the conclusion of this discussion, the focus will not merely be on the numerical value itself, but on the genuine underlying market forces that have powered this rapid and explosive movement. It's a chance to gain a deeper comprehension of the complex mechanisms at play in the multi-trillion-dollar foreign exchange arena. So, it is certainly time to prepare your notes and concentrate, as the next few moments will illuminate critical aspects of this market event that could profoundly influence your perspective on current trading prospects. Our exploration begins with an objective look at what this recurring 0.86 rate fundamentally signifies. A common but incomplete view suggests it is solely about the US dollar reaching a specific numerical value against another currency. However, the reality involves a much more intricate interplay of factors. This event is characterized by multiple, distinct currency pairings converging on a critical technical boundary, a level that has historically been proven to generate substantial trading interest and subsequent opportunities. The currency pair most frequently referenced in current market discussions regarding this movement is certainly the USD pair, though it is by no means the only one of importance. A number of other prominent currency pairs, including the British pound against the US dollar, GBP/USD, the Australian dollar against the US dollar, AUD/USD, and the New Zealand dollar against the US dollar, NZD/USD, are exhibiting corresponding technical formations when recent fluctuations in market volatility are taken into consideration. These patterns are not the result of mere chance or coincidence. They are actively provoked by the perfect convergence of multiple technical analysis indicators and powerful fundamental global market pressures, all aligning precisely at this specific price point. Traders who possess the skill to recognize these emerging patterns early on often position themselves favorably to capture significant gains. The current palpable excitement permeating the market is fundamentally fueled by the conviction that participants may be entering a comparable, high-opportunity trading window to one seen earlier this year. Grasping the core drivers of this rate and understanding the mechanism by which multiple, seemingly disparate currency pairs align simultaneously is absolutely essential for effectively navigating and participating in the current market climate. This convergence offers a clear signal of significant underlying shifts. To fully appreciate why the return to the 0.86 level is generating such intense interest, it is vital to reflect on the events of March of this year. It was during that time frame that this identical rate appeared, creating substantial and profitable opportunities for traders who acted decisively and early. Some accounts detailed gains in the range of 15% to 30% over a span of just 2 weeks, achieved simply by identifying the nascent pattern before the broader market fully assimilated the implications of the move. This success was not a matter of luck, rather, it was the direct outcome of meticulous preparation, solid market knowledge, and the careful application of risk management principles. As the market observes the 0.86 level resurfacing in the current environment, it is noteworthy that the prevailing trading conditions appear to be, in many ways, more favorable now than they were during the previous occurrence. Trading volumes are presently elevated, market liquidity has demonstrably improved, and key technical indicators are presenting even stronger confirmation signals than before. This powerful confluence of supportive conditions suggests that both novice traders and seasoned professionals could potentially encounter comparable, if not potentially greater, opportunities, provided their market approach is disciplined and strategically sound. Learning from past market behavior is a foundational element of effective trading, particularly when recurring, established levels like this are involved. One of the most significant fundamental forces driving the current surge around the 0.86 level is the set of recent adjustments in central bank monetary policy. Public statements and forward guidance from institutions such as the Federal Reserve have dramatically reshaped market expectations, directly influencing the projected trajectory for interest rates over the next half year. When the collective body of traders begins to anticipate these potential shifts, currency values react instantaneously and often sharply. Even seemingly minor alterations in official policy or subtle verbal hints delivered by central bank executives can be sufficient to trigger considerable market volatility, particularly when prices are consolidating near established critical levels such as 0.86. Consequently, a substantial segment of the trading community is currently concentrating its analysis intently on central bank communications and public announcements. Developing a nuanced understanding of the underlying tone and the broader context of these official announcements allows traders to make more informed decisions about positioning their trades. When this sensitivity to policy shifts is combined with the historical and technical significance of the 0.86 rate, it creates a robust environment that is simultaneously ripe with potential opportunities and characterized by heightened risk, necessitating vigilance and a cautious approach from all market participants. The second primary factor contributing to the significant activity around the 0.86 mark involves a notable, ongoing reconfiguration of global trade dynamics and commercial patterns. The implementation of new international trade agreements and substantial adjustments in global supply chains have collectively altered the conventional pathways and overall flow of currencies across national borders. These large-scale, fundamental changes are typically slow to fully manifest in observable price action, but their impact can be profound and dramatic once they do. Major currencies, including the Euro CUR, British Pound GBP, Australian dollar UDEG, and New Zealand dollars NZD, are all being impacted in distinct and varied ways, compelling traders to understand this wider economic context. It must be recognized that currency valuations are not solely determined by the decisions and actions of central banks. They are also intrinsically influenced by the massive, ongoing movement of physical goods, commercial services, and investment capital that continuously flows across international boundaries. When multiple, diverse currency pairs simultaneously reach similar, critical technical levels, it serves as a powerful and unambiguous indication that these deep-seated, fundamental economic shifts are generating a very tangible and measurable impact on contemporary market behavior. Astute traders who can correctly identify these interwoven patterns are better equipped to align their trading positions in a strategic and timely manner. The third crucial driver behind the movement is the widespread completion of significant technical patterns observed across an array of different time frames. This market event is much more comprehensive than simply a daily chart breaking through a singular key resistance level. Longer term charts, including the weekly and monthly views, are also displaying prevailing trends that lend strong structural support to the current price action. When short-term, medium-term, and long-term charts exhibit an aligned and confirming consensus, it constitutes a relatively rare and highly sought-after event that experienced traders monitor with great attention. Breakouts that occur at or around the 0.86 level are generally considered more statistically reliable in this particular context, because the technical signals derived from different scales of observation are mutually reinforcing. This strong technical alignment also provides a compelling explanation for the simultaneous and powerful market reactions currently being witnessed across a diverse range of different currency pairs. This phenomenon highlights a significant underlying market correlation that is often a prerequisite for a sustained move. Turning to the experiences of individual market participants, the reports coming in are quite telling. For instance, one trader noted capturing an 8% gain in less than a day by capitalizing on the euro, dollar movement near its 0.86 equivalent level. Another report detailed a similar success with the pound-dollar pair achieving a 12-cent gain across just 2 trading sessions by employing a straightforward, systematic trading approach. It is important to emphasize that these documented successes are not isolated or unique incidents. Over the past week, a significant number of traders have publicly reported achieving similar or comparable results. While these reported outcomes are undoubtedly impressive, it is paramount to understand that they are the product of rigorous planning, diligent risk management, and a sound comprehension of the prevailing market structure. Not every participant will experience these exact returns, and conversely, losses can materialize just as quickly as gains if the essential principles of risk management are not meticulously and consistently applied. Speaking of risk, it is absolutely vital to fully grasp the inherent dangers present within the current market environment. The level of volatility has increased beyond its typical parameters, which translates directly into the potential for larger profits, but also the commensurate potential for larger, more rapid losses. Current news events are having a noticeably amplified effect on currency pricing, and global political developments are exerting a greater influence on currency movements than is normally the case. The 0.86 level must be viewed as a point that embodies both a profound opportunity and an elevated degree of risk. Consequently, traders must manage their active positions with extreme care, make consistent use of stop-loss orders, and rigorously avoid the temptation to leverage their accounts. Neglecting these fundamental precautionary factors can rapidly transform what appears to be a clear and straightforward opportunity into a significant and costly error. Remaining fully cognizant of these inherent risks is an equivalent priority to recognizing the potential gains that the market presents. The two sides of the trading coin must always be considered in balance for any sustainable approach. One established and effective strategy for trading the current movement around the 0.86 level is commonly known as the momentum breakout approach. This method involves patiently waiting for the price to definitively pierce either above or below the 0.86 line, and then crucially, confirming that breakout with the aid of secondary volume or momentum indicators. A position is only initiated once this confirmation signal has been received. Traders utilizing this methodology are often advised to place their protective stop-loss orders at a reasonable distance below their entry point and to target profits that offer a favorable risk-to-reward ratio. This systematic focus on confirmed breakouts, rather than speculative guesswork, is a key way to mitigate risk while concurrently maximizing the potential for returns. This breakout strategy proves to be particularly effective in high-volatility trading environments, precisely like the one the market is currently experiencing. Another complementary approach centers on leveraging news-driven market movements. Close and active monitoring of the global economic calendar and strategically positioning trades just prior to major, scheduled announcements can yield short-term trading opportunities. Because significant news events have the power to create sudden and large price movements, it is generally recommended to utilize smaller position sizes when trading this way, which helps to mitigate the associated risk. Traders employing the news-driven approach must have a clearly defined exit strategy established and ready for implementation before any position is even entered. This method requires a significant commitment to active market monitoring, but it can be highly effective for those who maintain strict discipline and adherence to their plan. A deep understanding of how various economic data releases, shifts in trade agreements, and official central bank statements impact specific currency pairs is what allows traders to effectively anticipate and react to these rapid-fire movements in a strategic manner. The third viable trading strategy integrates traditional technical analysis with a measure of market sentiment monitoring. Traders can systematically look for currency pairs that are exhibiting technical patterns similar to the primary 0.86 movement, while also simultaneously tracking major social media platforms and trading forums for prevailing sentiment indicators. When the established technical signals align and confirm a broadly positive or negative market sentiment, initiating a position early can often prove to be profitable. This blended approach provides a more comprehensive view of the market's psychological state, which is especially important when multiple currency pairs are displaying correlated movements. In the current environment, it is unfortunately common for traders to make avoidable mistakes driven by excessive excitement or overconfidence. A prevalent error is the overuse of leverage. The prevailing high volatility conditions actually necessitate the use of smaller position sizes, not larger ones, to control exposure. Another frequent misstep is ignoring the broader market context. While the 0.86 level is undeniably significant, it represents only one component of a much larger and more complex market framework. Furthermore, traders often err by passively following the crowd, without genuinely understanding the rationale or analysis behind the positions being taken. Every single trade should ideally be grounded in the trader's own independent analysis, supported by a clear and documented rationale. Actively avoiding these common errors is a critical defense for a trading account against sudden and unexpected market shifts. Practical and prudent advice for navigating this period of high activity includes beginning with position sizes that are noticeably smaller than usual, with the intention to gradually increase exposure only as confidence and positive results accumulate. Maintaining comprehensive and detailed trade records is also essential, specifically noting which strategies are yielding the best results under these particular conditions. Flexibility and adaptability are key attributes for success, given that the market conditions are evolving rapidly, and a successful approach today may quickly become ineffective tomorrow. The use of multiple time frames to consistently confirm trading signals remains paramount, as a chart showing activity over an hour can present a vastly different perspective than one showing a full day's movement. Setting realistic profit targets and focusing on achieving consistent, smaller gains is a practice that often leads to superior long-term results compared to an aggressive chase for outsized wins. Vigilance for momentum signals is also warranted. A significant decrease in volume during a breakout or a trend that begins to move sideways can often indicate a weakening of interest and potential exhaustion. Unexpected releases of economic news possess the power to rapidly shift the market's trajectory, reinforcing the absolute necessity of always having a clear exit strategy formulated and ready for execution. Furthermore, the correlation between various currency pairs should be meticulously monitored. When multiple pairs move together in a synchronized fashion, it can be a strong indication of a robust, underlying trend. Conversely, if these established correlations suddenly begin to break down, it may serve as an advance warning signal that a significant shift in market direction is potentially imminent. Staying alert to these subtle but important signals allows traders to adjust their positions proactively before a major reversal potentially occurs. Central bank communications remain a primary engine driving the significant activity around the 0.86 level. Even the most subtle or minor changes in the language employed by policymakers can trigger a rapid and powerful market reaction. Traders must continue to pay very close attention to both the specific wording and the full contextual meaning of these statements. Comments and forward guidance from policymakers frequently precede large swings in market volatility, particularly when the market is poised at a critical technical level. The ability to correctly interpret these nuanced signals enables traders to anticipate potential shifts and position themselves advantageously. The significance, therefore, lies not just in the numerical level itself, but in the intelligent interpretation of the fundamental forces gathering behind it. The importance of sound risk management practices in this heightened environment cannot possibly be overstated. Traders should strictly limit the risk taken on any single trade to a small percentage of their total account balance and must avoid any temptation toward excessive leverage. Volatile markets can certainly generate rapid account growth, but they possess an equal capacity to liquidate accounts with startling speed if the appropriate safeguards are not meticulously and consistently implemented. The consistent use of stop-loss orders, detailed trade tracking, and maintaining strict personal discipline form the essential bedrock for long-term survival and success in the markets. Opportunities like the current surge around the 0.86 level are highly exciting, but they should never be pursued at the expense jeopardizing the capital in a trading account through reckless or undisciplined trading. For traders who are new to the markets or those who possess limited experience in high volatility environments, the practice of paper trading, using simulated funds, is an absolutely essential step that is highly recommended. Practicing new strategies without risking real capital allows traders to gain valuable hands-on experience and build confidence in their approach. Observing the market's reactions, actively testing breakout strategies, and conducting simulated trades during these periods of high volatility helps to develop crucial market skills. By the time a trader transitions to using real funds, they will be significantly better prepared to manage the inherent risks and capitalize on genuine opportunities. This systematic, practice-first approach also greatly reduces emotional pressure and actively fosters the development of a systematic, rules-based trading style. The practice of maintaining a detailed trading journal is particularly essential during a market surge of this magnitude. It is important to record not only the specifics of the trades executed, but also the emotional state and the precise reasoning that underpinned each decision. A high level of emotional awareness is a powerful tool for preventing the kind of impulsive moves that frequently lead to avoidable losses. Thoroughly recording strategies, entry and exit points, and general market observations helps in the continuous refinement of trading approaches and provides invaluable insight for navigating future market conditions. This discipline ensures that lessons are consistently learned and that traders can systematically improve their performance over time. The return of the 0.86 rate is undeniably creating measurable trading opportunities, but it is a fundamental truth that every opportunity is inherently accompanied by a corresponding degree of risk. Successful, long-term traders consistently prioritize detailed preparation, disciplined risk management, and strategic positioning. By truly understanding the various forces driving this movement, including central bank policy, global trade reconfigurations, and technical pattern alignment, traders can make significantly more informed and robust decisions. Employing structured trading strategies and adhering to personal discipline dramatically increases the probability of achieving consistent, positive results. It is important to remember that good trading is fundamentally a pursuit of consistency, patient execution, and adaptability, not a reckless attempt to hit a home run on a single trade. As always, trade wisely, maintain your discipline, and recognize that the mastery of market volatility builds a critical skill set that will benefit you throughout your trading career.